Over the past 2 months, Parliament and several state legislatures have passed laws related to GST. In the coming few weeks too, we are expecting to see different or several state legislatures passing GST laws. Passing GST laws means center and states can levy GST on the supply of goods and services across the country. In this video, let's see what is GST and how does it affect the indirect taxation system in the country. GST subsumes 16 different indirect taxes levied by both center and states in the country. In the current system, goods are taxed by both center and states. By center at the stage of manufacturing and by states at the stage of consumption. On the other hand, only the center taxes services. These taxes operate on the principle of value-added tax, where every dealer in the supply chain of a good or a service only pays tax on the value added by him. This means taxes paid on the inputs he uses will not be taxed further, and hence he can claim credit for that amount. This credit is known as the input tax credit. While input tax credit can be claimed within state VAT, service tax and excise duty, it is not available across these taxes. That means excise duty paid on manufacturing a good can further be taxed by state VAT, and input tax credit will not be available for this. This results in taxation of tax paid or cascading of taxes. GST subsumes all these taxes into one tax jurisdiction, so input tax credit is available across all goods and services uniformly. Also, tax rates on goods and services will be uniform across the country under GST. In the new system, when a good or service is supplied, both center and states will levy the tax together. For example, a car is sold in a state, center will levy the central GST and a state will levy the state GST. However, if a good is supplied from one state to the other state, for example, a car is manufactured in Tamil Nadu to a retailer in Madhya Pradesh, the center levies the integrated GST. The revenue will be shared with Madhya Pradesh, which is the consuming state. Every business with annual turnover over 20 lakh rupees should be registered under GST, and in every state where he conducts his business. For some special states such as northeastern states, this threshold is just 10 lakh rupees. Under GST, tax rates will be decided and recommended by the GST Council. The central GST's tax rate cap is 20%, and so is the state GST's cap. That means that both state and central GST tax rate should not exceed 40%. Recently, the GST Council, consisting of central and state finance ministers, met in Srinagar to finalize these tax rates. The council classified various items into 5 tax slabs of 0%, 5%, 12%, 18%, 28%, and some items on which a cess will be levied in addition to GST. Some daily items like wheat, rice, milk, meat, and fish will not incur GST. Some services such as healthcare and education were already exempt from the ambit of GST. While allowing for a multi-tax rate structure allows for some common items to be taxed at lower rates and luxury items to be taxed at higher rates, there could be some challenges. For example, in 1999, dispute came up when it was challenged whether Kit Kat should be taxed as a biscuit or a chocolate. More number of tax rates or tax slabs can create disputes over classification of goods and services. As a result, while GST Council has decided the rates for most products, some other like footwear, biscuits and gold are yet to be decided. One thing to think under GST is how will it impact the revenues of states. Under GST, it is assumed that states will see a tax revenue growth of 14% annually. If there is a shortfall in the next 5 years, center will compensate for that. Center will use the revenue generated from the cess levied on the highest tax bracket. For more information, please log on to prsindia.org.